Hey folks, I have some exciting news from you. The Fed just came out and said they don't expect to raise rates until 2023. Well, my name is Dan Freer and I'm doing this report on September 27th, 2023. So when was this thing published? Well, you'd be surprised. It wasn't too long ago. Let's go over to here and see when this thing was published. It was published March 17th, 2021. So what's happened since that time, since they actually came out and said, well, we're not going to raise rates until at least 2023? Let's get over to see what they did. Well, in 2022, it was a year later from this post, because remember, if you go back to this post, it was posted when? March 2021. Well, in March 2022, they started this rampage. So in March 2022, they raised rates. May raised rates. June raised rates. July raised rates. September. I won't go through the whole thing. You get my point. So does the Fed really understand the economics behind things? Because why would you come out and say, well, we're not going to raise rates until 2023. Then a year later, they have the most rapid increase of rates ever. Well, the main reason is inflation. But the bad news right now is good news is bad news, and now bad news is bad news. So let me explain what's going on. Let's go to the economic calendar that we have for today, and you can see where basically any news right now is just construed as bad news, because if it's actually good news, they're saying, well, the Federal Reserve, that's good news, so the Federal Reserve is going to keep raising rates. Well, if it's bad news, well, the stock market crashes and everything else crashes. So we can't really win in this scenario. So what I want to educate you guys on a daily basis is the economics behind all of this stuff. So what we do on a daily basis is we go to our economic calendar, we break down what's happening today, the news that was posted today, and then I extrapolate that out and say, okay, based on this news, here's what should happen. But unfortunately, it's a different world today because, like I said back here, good news is bad news and bad news is bad news. So let's get over to it. The first thing we want to go through is the economic calendar it's actually Wednesday, but I want to show you guys what happened yesterday. And you guys tell me if this is good news for you and me, good news for the economy, or maybe it's just good news for the Fed. So let's go for the first thing we want to look at is building permits, because we know there's no houses on the market. That's why houses haven't crashed in value, but there's no sales. We're going to have probably a record sales, low in sales probably that we've ever seen, well, in years and decades. I think it's 2 or 3 decades since we've been this low in the number of units of homes being sold. But let's get over to the numbers we have right now. Building permits, they're up, and they're up month over month, and that's a fantastic basically news for us because we need more houses to kind of stabilize the markets. But let's get down to some of the nitty gritty here. Building permits, it was expected to come in at 1.54 million, came in right in point. Here's the Case-Shiller index. Now this is the weird area where people, you watch YouTube videos and you watch mainstream media and they're like, house prices, they're going to get crushed. And they've been telling us that since at least 2021. Well, the S&P, the Case-Shiller index that we have right here, this gives us the gauge on what home values are doing. You have year over year, this is right through here, and you have month over month, and I can explain that to you right here. The S&P Case-Shiller index measures the change in sales price of single-family homes in 20 metropolitan areas. Okay, so what you're seeing right now is home prices. They were expected to go, or last reading, they were up 0.9%. Home prices are still up this year, folks. They're up 0.6%. This is just in 1 month. Over the year, it's not exciting, but we were at a negative 1.2%. They expected it would come in at negative 0.3%. It actually came in at a positive. So where is the crash? It's not there, but it's in the reflection of the number of units sold, because I understand it is truly hard to afford a house right now, but you're going to have some reprieves, and I have a video coming out later today that's going to help you or help educate you guys on how, even though rates are at 7.5% today, how can you get and qualify for a 5.5% rate? I'll have that video out later today. Then we have consumer confidence. This thing is falling off a cliff. The last reading came in at 108. It was supposed to come in at 105, came in at 103. Okay, new home sales. Last reading was 740,000 units sold. This time 675,000. Good news or bad news? Well, you determine. The new home sales, we got that. Let's go down through here. Now, what we have so far today is core durable goods. Now, this number kind of shocked me a little bit, but I did a little bit of research. What core durable goods is, how much goods and products are we buying on a bigger scheme? Like, have you bought an oven lately, or a refrigerator lately, or a washer and dryer lately? Those are durable goods. Those are bigger units. But when this number came out, I looked at it and said, wow, that's 4 times what was expected. So you have to really dig into the details, because my goal here is to explain the whys for you behind the scenes. So if you look into this, durable goods orders climbed on higher military spending. What happened? The number of orders for long-lasting durable goods rose stronger than expected, 0.2% in August, but the increase stemmed from higher defensive spending on the U.S. sought to replenish the military hardware sent to the Ukraine. Okay, so you have to really understand the dynamics of this, and then that's the rest of the news today. Tomorrow we're going to have GDP, we're going to have some other major events that the Federal Reserve is going to monitor, and then on Friday, the infamous, drum roll please, PCE. Now the PCE is basically the inflation number that the Federal Reserve gives most credence in. It's expected to stay steady at 0.2. Year over year, it's supposed to come down. So we're going to follow that all week long. So let's get over to some of the nitty gritty that we're seeing right now. What I want to explain to you guys is the new dot plot was just released from the Federal Reserve. So what I want to show you right here is the new dot plot. And there are major changes here, folks. So here is where we are right now. The median rate right now on the federal funds rate is 5.6%. It's actually 5.5 right now. This is saying the median is 5.6. Okay, so that's where we're at. Where do they expect it now to be in 2024? These are major revisions, but folks, they revise this every 4 months, okay? Just like they do over here when they tell us that they're not going to raise rates for at least 2 years, and then within 12 months, they have the most rapid increase that we've ever had in history. So take note of this, but let's just dissect it. You have inconsistencies right here. Look at where we are right now. So what the dot plot is, basically, let me explain this to you. The dot plot is when the Federal Reserve meets every 6 weeks, all the members of the Federal Reserve, they sit there and they put a dot in every year on where they expect the federal funds rate. Now, the federal funds rate is basically interbank lending. It's not rates that you and I pay. So basically, if interbank lending, they charge each other higher rates, well, they're going to pass those higher rates on to us. So you can see right now, the federal rate here, the consensus vote is they want the federal funds rate right here. That's 5.75, okay? And you can see it's a consensus between 5.5 and 5.75. That's where every one of them voted. Now you go over here and everybody's saying, well, it's going to be higher for longer and we're going to have more rate increases in this thing. There is so much indecisiveness in this. Look how sporadic these numbers are. And then you go out to 2025 and basically nobody's agreeing on where they're going to be. So we have to give this a little credence. Okay, so that's what I wanted to talk about today is basically the economic calendars, how the Federal Reserve, basically it's a moving target that they give us. And it's very confusing going back to what we said initially is bad news or good news is bad news and bad news is good news, because everybody, even mainstream media, they're just pumping fear and everything else. Why? Well, because it sells. So let's get over for next to see where the bond markets are. This is the bond markets that I follow on a daily basis. So what you're seeing on your screen right now is the 10-year Treasury. That's the bonds that the government issues when they run out of money and they need money to fund the government. So that's those over there. They're going to be crazy in the next couple days because the federal government is possibly in shutdown mode. Relax, folks. The older you get, you'll understand that every presidential cycle, they go through this and each party just points their finger back and forth. But then when it comes down to the deadline, something will get resolved, okay? So there's the 10-year Treasury. We don't follow that. What we do is we follow a mortgage bond. Why? Well, why would you follow a 10-year Treasury when you can actually follow a mortgage bond to tell you where mortgage rates are going? So this bond right here that you're seeing, the yield on that bond is the biggest component of mortgage rates. Okay, so that's why I follow this meticulously. If you squint, there's a green number up there, and we usually do not see green. That means the price of the bond is going up. It's fantastic news because the price of the bond and the yield are inverted. It's yin yang. If one goes up, one goes down. So this means that rates are going to start to ease a little bit. How much? I don't know. Because again, I'm going to repeat this dead horse. Because good news is bad news and bad news is bad news. So let's see where rates are right now. These are the top 6 products people use when they're buying or refinancing a property. So the scenario behind this is Mortgage News Daily surveys mortgage lenders all over the country, and they ask them this. They ask them 5 main questions. They said, if you had somebody buying their first house, and it was going to be their primary home, the house they live in, and it was a single family home, wasn't a duplex, wasn't a 4-unit, it was a single family home. Now, the credit criteria is they have a 740 credit score, and they're putting down 20%. Now, let me explain something. You don't need a 740 credit score to qualify for a home loan. You need a 580 to qualify for a FHA or government loan, and a 620 credit score to qualify for conventional financing that you have over there on the 30-year fixed. Now, I also said that they're putting down 20%. You don't need 20% either. Most cases, if you're a first-time home buyer, you only need 3% of a down payment. Okay, so that's what most of our borrowers are doing. So you can see right here, these are where mortgage rates are on the top 6 products issued by Mortgage News Daily on a daily basis. So if you're out there and you're like, hey, Dan, how do I even find out? Can I qualify to buy a house in this market? You know, the first thing I would ask you is your market deemed a good area to buy? Okay, so if it is, or you want to kick the tires there, we have a new link down below, and it's getting you connected with a realtor in your area. What we've done is we've partnered up with RE/MAX, and they're going to offer our free service for you guys to vet realtors in the area that you're looking for. So please check out that link down below. And but what I ask people to do is don't disqualify yourself. Please reach out to us. We would love to help you at least navigate this process. You might say, you know, my credit score is this. You know, would I qualify with that? You know, I make this much money and maybe I only have this much of a down payment. What can I do with that? So what I'd ask you to do is don't disqualify yourself. Reach out to us. There's 3 ways to do that. Right up there is an apply now button. The cool thing about that is you're not actually applying for the loan at that point. What we're doing is kind of asking you a series of questions to figure out what specialist on my team you need to talk to. Are you looking to build a house? Okay, you might be talking to me actually. If you're looking for an FHA or a refinance, you might be talking to another party or another person on my team. So how do you do that? You click that button, that'll take you there. But if you're like, Dan, how do I just reach out to somebody? I really would like to talk to somebody now. Well, great question. All you need to do is give us a call, 844-775-5626. Or if you want to reach out to me directly, just give me an email at dan@therateupdate.com. Thanks so much for watching, guys. I appreciate it. If you find value in my channel, please, all I ask you to do is if you haven't yet, hit the subscribe button down below so you get alerted every time I post a video. Take care, folks. God bless. Have a fantastic day. Bye-bye.